Hey everybody, this is Chaz with Churchwell Insurance Agency, your lender's tool. So wanted to talk to you real quick and just do a run through with you over the next 10 to 15 minutes, kind of a 101 on understanding homeowners insurance for mortgage lenders, even for realtors as you're kind of going through the process. Here's the reality. Your clients think that you are supposed to be a professional with a wealth of knowledge of all things involving the entire home purchasing process. You and I both know that's not what your job is supposed to be, that you're supposed to use the tool belt around you for realtors, for inspectors, for insurance people. So just wanted to go ahead and give you kind of a 101 tutorial on homeowner insurance that hopefully will be a blessing to you as you're engaging with your clients. And so let's look at it. So why are we here? To familiarize you with homeowner and property insurance, to help you become more valuable as an asset to your clients, and to share how Churchwell Insurance Agency can be a powerful lender's tool for you. So homeowner policy components, let's dive into it. There are 6 basic parts to your standard homeowner insurance policy. You're going to have coverage A, which is your dwelling, coverage B, other structures, C, personal property or contents, D is loss of use, E, personal liability, and coverage F, medical payment coverage for others. We'll dive into these kind of as we go over the next few minutes, but let's think about this. Your client has a total loss on their home. How are they going to be rebuilding that house? That is what we're going to be here for, to make sure that if they have a total loss, how can we make them financially whole again? Well, that all starts with coverage A for your dwelling. This is the part for the main structure on the property and any structures that are attached to it. Like if there's a garage attached, or let's say that you've got a patio that extends off the top of it. That extending patio cover would be part of the attached structure. If you've got something that's bolted onto the house, that's going to be part of the attached structures, and it'll all be under the dwelling amount. So it's going to be it's going to be based on the replacement cost. And we're going to do that using an estimation calculator. We're not going to do that based off of loan value, market value, appraised value. We want to make sure essentially that we have enough money to make them whole again if they suffer a loss, and to be able to rebuild a brand new 2017, 2018, whatever year it is, model house for whatever that year is that we're in where they have the loss. You'll see that coverage is going to be subject to a deductible. And the dwelling amount used on your coverage A is actually going to be used to calculate some of the built-in limits for coverages B, C, and D that we'll check out here in just a minute. So here's what we're going to talk about: replacement cost versus market value. A lot of times when I'm talking to clients, we're going to run into issues to where they're thinking about market value, what they're buying the house for, and what it can be sold for, bought for in a given market. We want to worry about what does it cost to handle the demolition, debris removal, and then a complete rebuild at a non-bulk rate for labor and materials. For insurance, you always want it based on that. Most of the time, your underwriter is going to want it based on that anyway, but you'll find that there are some agents that'll short rate that, and they'll cut corners on that if they can on the calculator, and then just try to build it up with an endorsement later. You don't want to do that, and we'll talk about that. Market value defined. You're going to see that insurance coverage is not based on market value, since that includes land. And then insurance coverage is not based on market value, since market value cannot make the client whole again financially if there's a demolition, debris removal, and rebuild that exceeds market value, which is usually the case. If you're in a higher end community, like in the Charlotte market, you've got South Park, Dilworth. If there's a house in there and you do it for market value, yeah, that might be fine. But for most homes, you would find that that wouldn't be the case throughout the Carolinas. Coverage B, other structures. Other structures coverage is going to be something that's detached away from the house. This might be a swimming pool. It could be an outdoor kitchen or bonfire area that's kind of landscaped out. It could be your fence or a hot tub that you've got sitting out there. Those are going to be detached structures. It could be a shed, a mother-in-law cottage, things like that. You'll find that it is subject to deductible, and the limits can be increased to accommodate the higher limits. But again, it's going to be a built-in 10% off of the dwelling amount. So if your dwelling is $400,000, then you would have a built-in coverage amount of 10% of that of $40,000. So again, detached structures, sheds, pools, fences, just to kind of give you some examples. Coverage C, personal property. This is going to give coverage for your belongings that are in your house that are damaged due to a covered loss. The best way I like to explain this to clients is if you took your house and you flipped it upside down, anything that fell to the ceiling is going to be personal property. A lot of times they think about their clothes, TVs, couches, and things of that nature, but they may not think about other things. Prime example, if you've got a slide-in stove, a slide-in stove is not built in. It's not bolted to the home. Ergo, it's actually going to be personal property. Your refrigerator, if you've got a $2,000 slide-in fridge, that's personal property because that thing's not bolted to the home. So you'll see that depending on the insurance carrier, it is going to start with coverage of 50 or 70% of the dwelling amount. So again, if you've got a $400,000 house, if you have 50% of that, you may have $200,000 for your contents coverage going up for 70%, things of that nature. And you can increase that coverage. So coverage is going to be subject to the deductible, and it contains an internal cap limit for certain categories. This is huge. I run across clients regularly who don't even know about this, but you'll find things such as jewelry, artwork, musical equipment, camera equipment for antiques and collectibles, things of that nature. Those are all going to be capped on those different categories built in within the policy. So you could have $200,000 of contents coverage, but you may only have $1,500 of jewelry coverage total on the policy. Then you'll see that it's going to include 10% of the amount for contents away from premises. I had a gentleman who his car got broken into just recently, and he's like, man, do I even have coverage on this for my auto insurance? I was like, no, you don't. But you do on your homeowner's insurance. And since he had $150,000, something of that nature, on his homeowner insurance for contents, we were able to cover him for $15,000 of coverage away from premises, of course, subject to the deductible. Coverage D, loss of use. This is really simply put, if you lose use of your home, then you've got coverage here. If it's due to a covered loss, coverage is going to start at 20% of the dwelling amount. So if you've got a $1,000 or $100,000 house, then you're going to have $20,000. $200,000 house, $40,000, things like that. You can increase the coverage on some policies. Coverage is not subject to a deductible. So basically, if you end up having to stay in a hotel for 3 weeks while your house gets put back together from some damage, you're covered on that. If it's 6 months to do a rebuild, then you're covered on that. They're going to take care of your housing. If you have to drive further to work, they're going to pick up the extra fuel cost and mileage. If you find that you're having to eat out more than normal because you don't have your kitchen to operate from, they're going to cover that. Those are all loss of use expenses. So coverage E, liability. This is going to be coverage that's going to take care of you for defense and settlement if you're sued and found negligent for injuries or personal property damage to somebody else. For a prime example, if your dog bites somebody, or if you have a contractor in your house and they fall off a ladder at your home and decide to sue you, I've seen it happen, then you'll see that this is where your liability coverage is going to come in and protect you. Coverage will typically begin around $100,000, and clients can increase that. I never recommend a client has less than $300,000, and to truthfully tell you, you should really have at least $500,000. The difference between $300,000 and $500,000 is only $4 on a policy for a regular homeowner policy. So Why would you not pay $4 extra to get $200,000 in coverage? Now, the cheapest asset protection that a client can purchase, like I was saying, to jump at $200,000, it's only $4. Why would you not, right? Coverage is not subject to a deductible, which is a great thing. So just kind of as a bonus on this, people, a lot of times they don't know about what umbrella policies are, but you'll see that it's not uncommon for us to take umbrella policies and lay those over on top of a home, auto, watercraft, motorcycle, things like that. And that can give you additional limits that'll do increments of $1 million for a very cheap price. Often 180 to 250 bucks will get you $1 million of asset protection for your clients. So coverage F, medical payment. This is basically what's going to allow friends to stay friends. If you know that your friend doesn't want to sue you, but I mean, they got hurt at your place or your dog did bite them, something of that nature, then it's a goodwill coverage that's going to help prevent a lawsuit from happening from the liability section of your policy. It's not subject to a deductible. It starts typically at $1,000, but you can go up to $5,000 on the increment. So let's talk about different types of homeowner policies. Most property policies are going to go under one of the following. HO3, this is your most common homeowner policy, what most people are going to get. There's another policy that's a little bit better than an HO3. It's called an HO5. Most companies don't write those. There's a couple of them out there that do, but you'll find that for the most part, we're going to write either an HO3 or we're going to write an HE7. Typically speaking, I can get an HE7 for a client cheaper than I can get an HO5. So you'll find that we don't write HO5s very often. It's typically going to be an HO3 or an HE7. We'll get into that in a moment, kind of comparing, like looking at all these different types. HO4 is going to be a renter's policy, not really going to apply to you guys, except for when we have somebody to where I've seen it happen, to where a closing gets delayed, but the client is already moving in and we need to go in and we need to write a renter's policy for them for like 3 days of coverage or something. HO6 policies, that's going to be a condo policy, studs in. I find that there are people who get confused on the term because it's called a condominium policy, but you'll see that townhouse policies are also written on a condo policy form if there's an HOA that's insuring the studs out section. So just want to make sure that you understand on that, because sometimes there is confusion that's there. A DP1 is going to be written as a builder's risk policy or a vacant policy. A lot of people don't know, but vacant homeowner policies are wildly more expensive than a regular homeowner policy. And then you've got your DP3 policy, which is your typical landlord policy. If you own a house and you're renting it to somebody else, that's a DP3. That's what it should be written on. Some people will wrongly write a DP1 or a DP2 just trying to do it on price, but I would never do that kind of thing for a client. And then you've got a mobile home policy, a manufactured home policy. So what are your biggest impacts on premium? What does it look like whenever you're trying to estimate what the insurance is going to cost? Because I know you guys, you've got to throw estimates in there for the hazard insurance. So big things. I see that clients will be blown away because they may come to me, and even lenders will be blown away sometimes. They'll come to me with a house that was built in 1980, and it's in a smaller, maybe even a smaller community, maybe even a little bit on the rural side. And that house, land value is really cheap there. So maybe, and the build quality might be very basic. So you're going to find that the house might be a $190,000 house, but it's it might be a 2,000 square foot brick ranch with a basement. And when you do the cost to rebuild on that, if you were to try to rebuild a brand new version of that house, it could easily be a $200,000 to $225,000 house to do a 2,000 square foot full brick ranch with a basement. So it's one of those things to where age of home can really, really impact that stuff. You'll also find that if it's a brand new home on the other side of it, brand new construction homes, we have carriers that'll give you a 40% discount for brand new construction. But the thing is that we try to tell our clients, hey, look, you're getting a discount for brand new construction, because the reality is insurance companies know that not a whole lot's going to go wrong on new construction most of the time. So what they're going to do is we tell the clients to expect that their insurance rates are going to tier down on the discounts and tier up on the price because they're giving it a brand new construction discount. That 40% will go away over about a 5-year stretch. Additionally, is the property located east or west of 95 here in the Carolinas? Are you in the wind pool area to where you're in that hurricane zone? That can make a massive impact on premium, and it impacts what companies will even be willing to write the policy. So is it rural or is it a developed area? There's something called fire protection classes. Depending on what protection class it's in, that'll impact the premium. What ratings do the fire departments have in that area? Things of that nature. How far away are they from a fire hydrant and from a fire station? How custom built or basic is the build quality? That can be huge on the cost to rebuild. You could have a very old home, turn of the century, but it's got beautiful, intricate millwork that's in there, things of that nature, and it's got gorgeous tile work throughout it. Are we going to be insuring it to that level of rebuild for that kind of care and quality on the construction? And then we're going to look at credit. In North Carolina, South Carolina, they do factor credit in there. But we do it as a soft touch, so it doesn't really impact what you guys do, obviously. And detached structures, you're going to find that detached structures are going to be one of those things to where if they've got an $80,000 workshop and a $150,000 house, remember, it's 10% of coverage A, so it's $15,000 for other structures coverage built in. If they've got an $80,000 workshop that we've got to rebuild, then that means we need to bump up their other structures coverage by $65,000. Deductible, that can be a huge factor on premium, especially in wind and hail areas out towards the coast east of 95. And then I'll tell clients regularly, if your house is over $300,000 to $350,000, you're probably going to want a $2,500 deductible because you will see a significant savings there. Multi-policy discounts, that's going to be a massive thing. The more that we can bundle together for them, it can be significant. It's not uncommon for us to see on some of our carriers like Travelers, a discount on the homeowner side could be $200 to $250. And then there's companies like Kemper, which are really good if you have good credit and if you write your auto with them, because they won't write the home without the auto. They'll give you a homeowner price that is usually untouchable by a few $100 compared to everybody else. So the multi-policy discounts that you can get can be a huge game changer. Centrally monitored alarm, it impacts premium, but here's what I want you guys to know. I usually don't tell clients to get a centrally monitored alarm system because they want a discount. I tell them to get it because they want peace of mind. The discount's not that significant, but it is there. And then obviously we're going to look at claims history. I'll let you know that we do have carriers that they will look back only 3 years instead of 5. I've also got carriers that will, if there's a claim that's associated with weather, they will forgive the first weather claim and not even count it against the client. So if we've got situations to where there's a DTI issue and they've got bad claims history, then we might be able to help them out in that matter by utilizing one of those carriers. Additionally, you'll find rebuild cost. That's going to be huge. We make sure that we get the rebuild cost right, and then we try to work everything from there. So let's talk about the different policy types. The first thing, and I know it's a little bit squinty, whatever on here, but I wanted to make sure you know, what is an HE7 versus an HO3? I'm not going to really dive into the HO5 since it's kind of stuck right there in the middle and not typically the most competitive, but an HE7, when we put the 21 endorsement on there, which is what we always do, and I know that that's kind of techno-garble, but just know that when we do an HE7, that's how we do it. We do that versus your standard HO3 policy, you're going to see that additional replacement cost is going to be built in by a standard usually of 50% instead of having to add it on by endorsement. You'll see that other structures coverage, instead of just giving 10%, these guys are going to build it in at 20%. You'll find that for personal property coverage, a lot of HO3 policies are just going to give you 50%. On an HE7, they're always going to do it at 70%. And then here's a cool thing. You'll see where it talks about perils insured against, open peril versus named peril. This is the easiest way I can explain this to you. An HO3 policy is going to be pretty much something to where they're going to name the things that they actually cover. They're going to tell you, we're going to cover this specific list of things, but everything else is going to be excluded. An HO7 or an HE7 policy is going to say, we're going to exclude coverage for these specific things, but if we didn't list it as excluded, then you're covered. So there's a whole lot more times on an HE7 that they're going to say yes to a loss being covered than what they will on an HO3. It's a far more comprehensive policy. If you look at these underlying limits, I'm not going to tear through all of them, but you'll notice on specialty limits of liability, I've told you that there's different things to where they put caps on stuff. You'll see that a lot of times jewelry, money, securities, your watercraft coverage, which the watercraft coverage, don't get me wrong, that's pretty basic. You're talking about like if you've got a little, if you've got like a couple little kayaks sitting at the house, a canoe, maybe a cheap pontoon boat that's got a low horsepower on it that's only worth a couple of grand, something like that, or a little aluminum boat. That's the kind of stuff you're looking at there. You'll see that you're going to have your business property at residence coverage is doubled. For a lot of clients, that can be a big deal if you've got a good laptop that you bring home, things of that nature. And then your coverage for being away from residence is going to be tripled up, things of that nature. So additional coverage, you'll see that shrubs, plants, fire department coverage, all this kind of different stuff. It's going to be far more comprehensive on the HE7 than it is on all the different ancillary coverages than you'll see on a HO3. Now, homeowner insurance add-ons. Here's some of the most common endorsements that we're going to see that are going to impact your premium. Replacement cost, by adding on the replacement cost coverage for contents and dwelling, you'll see that for dwelling, we're always going to add that on there. Contents, we're always going to add that on there, but not everybody does on contents. You'll see that that might be an area to where it could impact premium. But if you don't have contents at replacement cost, then they're going to basically get their stuff replaced at the Craigslist value. Additional replacement cost. Water backup coverage. Additional replacement cost is basically saying 125% or 150% of the guaranteed replacement cost on an HO3. Water backup. If they ever have any of their pipes in their house get clogged and as a result water backs up, overflows, and causes water damage, there's zero coverage unless that's listed on their policy. And then scheduled property could be things such as if you have nicer items for jewelry, fur, fine art, antiques, collectibles that would go beyond the limit built in on your homeowner policy. You want to make sure that we have that scheduled on there for extra coverage. We can put it on a separate policy for them so that it doesn't impact any DTI issues. And then the HE21 endorsement that we put on for an HE7. So HO6 condo policies. This is going to be your studs end policy. Typically, you'll find personal property coverage on there is going to be name peril. Condo is name peril, just like an HO3. And then loss assessment coverage is going to basically be for losses assessed to each owner by the association. And it'll be available in limits that can be tacked on up to $50K. And you'll see that what walls in means, it's going to be your flooring, your cabinets, your built-in appliances, anything that's permanently studs in. I'll tell you that on average, we usually do 33% of the market price in most markets. Again, if you go to some place like in the Charlotte market to where you've got Dilworth or South Park, we're going to temper that back a bit because land value is so expensive. Homeowner HO4. This is the renter's policy, name peril for tenants, renters. It's replacement cost, which is not always included, but we tack it on because that's how we roll. Dwelling fire 1. So designed for structures that are vacant due to being on the market, under construction, or between tenants. Coverage includes ACV on the structure, which is actual cash value. We'll dig into that in a minute. Theft for building materials can be endorsed on, and fire, vandalism, and malicious mischief as covered perils, but it's not going to hook you up if there's water damage, just so you know. DP3 policies, designed for structures that are vacant due to being non-owner occupied, vacant because of vacation or season rentals. Coverage is going to include loss of use coverage for loss of rental income and landlord ability or liability for claims arising out of their tenant exposure. So manufactured homes, replacement cost versus ACV. This is kind of a big deal. Most of the manufactured home policies out there these days are going to be writing on actual cash value. We have a company that'll do that, but we typically like to write replacement cost because of this simple formula right here. Total loss payout depreciation, or pardon me, the total loss payout depreciated minus the deductible versus the true replacement cost minus the deductible. So here's what you'll see. We like to use, and this is going to be the brand new replacement cost, and this is what we like to use. Because if you use this part where it's going to be a partial loss payout depreciated minus the deductible versus true replacement cost minus the deductible. We're talking Craigslist used items. So really, guys, what you're talking about is, do you want them to be able to go out and to buy a brand new 2018 manufactured home to replace the one they lost and to buy brand new stuff in their home? Or do you want them to be able to only go out and buy another used trailer to roll it in there? Additionally, if they have partial losses on the house, let's say that they need a new $4,000 roof and they have a $1,500 deductible, that leaves $2,500. They're actually going to say, oh yeah, your roof was 15 years old and the actual cash value of what that depreciated value is on that roof is only $800. So we're not going to give you $1,500. We're only going to give you $800. And so now they've got to come out of pocket for $1,500 for their deductible and another $700. $2,200 for a lot of people that are purchasing manufactured homes is quite a bit of cash, because they're only going to pay the depreciated value for even partial losses. So how do you estimate cost on manufactured homes? I'll tell you that typically you want to use about 75% as you're trying to just guesswork on it of the square footage. It'll be an ish kind of thing. But replacement cost, you're typically going to be at 90 to 95% of the square footage ish. So if you've got 1,200 square feet, then you need to figure the price for that is probably going to be, if you want to do a replacement cost policy, around $1,100, $1,050, something of that nature. I'll let you. I don't like selling the ACV policies on most mobile home purchases. Just so you guys know, I don't think that it's a right thing to do by the clients, even though the premium is cheaper on an ACV policy. Flood insurance. Homeowner insurance never covers flood. Do they have a flood elevation certificate? That's a huge deal for us in most cases. If you're needing it, then we probably are looking for a flood elevation certificate. Sometimes required by mortgage companies, depending on the flood zone of the improved property. So let's chat about that. A lot of times you're going to find that, and this is something where you can battle with an underwriter about this to try to get the client taken care of better. If the home itself is not inside, the improved structure is not inside of the floodplain, it can be on the property, but not inside of the house. Like if there's a little sliver of a line for where that flood zone goes across the house, the roof line, anything, then it's in the flood zone, even if it's just a little corner of it. But if part of the land is in the flood zone, but not the structure, then a lot of times you can actually work with your underwriters to get them to go ahead and say, hey, I've talked to the mortgage or to the insurance companies. They're saying that the house is actually in flood zone X, but it's just the property itself has a portion that's in AE. So do we really need to get flood insurance on this? And that's something we can work with you on. So everybody is in a flood zone. It's just a matter of which one are you in. Flood zone is going to be, or flood is provided by the National Flood Insurance Program up to $250K. Sold through private carriers. You'll find that over $250K, we can write excess limits, and I double typed written there. Sorry about that. To get coverage through a private market to go whatever limit they needed to head up to. So how do you get the lowest possible escrow numbers for your borrowers? That's a big deal, right? You want to work with an independent agency like Churchwell Insurance, who can compare your borrower's coverages and pricing across a ton of different companies and make sure that we're getting the best possible pricing and coverage for them. So also you're going to find that we want to make sure that we're nailing quote accuracy. This is crucial. We want to make sure that we're hitting all the discounts And we want to make sure that we're getting accuracy for you on coverage A, and that we're nailing things like what's their education level. If we talk to them about getting a multi-policy discount in play, that can swing the premiums significantly. 20 to 50 bucks a month just with a multi-policy discount, right? You'll find that coverage A limits are where a large part of the premium is going to come from, and we're going to make sure that that limit is as accurate as possible by getting a detailed replacement cost analysis on the property. And so this is why we invite our clients to make sure that they either connect with us by phone or that they go online and complete our secure and encrypted quote form that we've got out there. So you'll find that additionally, the third thing is you want to make sure that your clients maintain a sensible deductible. We'll work with them and play through the numbers, everything of that nature. But you'll find, prime example, if somebody's got over a $350,000 house, they really don't want to have a deductible under $2,500. It's price advantageous for them to go to the higher deductible, things like that. Bottom line, just kind of recapping, you can trust Churchwell Insurance Agency to work hard with you for your clients. You can have your clients reach out to us directly, or you can actually go and have your processor go to lenderstool.com, and you can actually request right there that we instantly reach out to your client. And when I say instantly, I literally mean instantly. We're going to reach out to your clients. We're going to shoot a text message over to them. We're going to hit them with a video, and then as soon as we see what's going on, we're going to follow up with a phone call. But we're instantly making a touch to them, trying to get connected. It gives you a place to where you can upload any documents you want, like a 1003 form or a flood elevation cert, whatever you would like to. But you don't have to upload those things. And then when we reach out to them, we're going to let them know, hey, let's get scheduled on a calendar for a call. And also, we invite them to go ahead and fill out our secure and encrypted form online so they can, before we even get on the phone with them, they can already have all the information over to us, which makes our time more efficient and more powerful so we can get quotes over to you and evidence of insurance over to you even faster. That's how we want to be a lender's tool in your tool belt. So again, my name is Chaz with Churchwell Insurance Agency. Thanks so much for the opportunity to work hard with you for your clients. Hopefully you found this 101 course to be beneficial. Blessings. Bye.